doing is that there are now roughly 4,000 banks in China. Most of these are small and medium-sized banks. And many of these banks are now in some sort of difficulty. So they're moving towards a consolidation of these banks into larger entities, which might have more survival potential, or that can actually weather this crisis. So lots of changes afoot in China in the areas that we have been working on. By the way, the total assets of these 4,000 banks of many different sizes is an incredible 10.9 trillion US dollars. So it's we're talking about assets that are almost equal to the size of GDP. GDP is, of course, higher, about 13 plus trillion dollars in dollar terms. So we have quite a situation out there. I'm thinking, looking down the road, that probably again we're going to see growth rate of GDP probably maybe in the 2 to 3% range at best, and worse in many other countries. Okay, any questions before we turn to fintech? Anything which you have heard, which you come across in some lectures that is of interest? Anything happening around SaaS that is interesting or notable?
Professor, do you have some comments on the oil price issues?
Oh boy, yes.
And right now, because recently the Bank of China have a big scandal about their oil future like investment fund or whatever, and that really caused a lot of controversy in China. So I'm wondering if you have been following that as well. Yeah.
That one I haven't, but I have been back and forth with people about what happened, because a month and a half ago, I was discussing with people about the likelihood of negative oil prices. And at that time, what I had in mind was that there'd be 2 or 3 factors that would determine whether you have negative prices. And one was firstly, how much demand would go down. It's gone down by 1/3 globally. So from 100 million barrels a day, it's now roughly 65 million barrels a day. So enormous drop. Secondly, how much would production be cut back? And the 3 big players are Russia, Saudi Arabia, and the United States. How much would they cut back? They didn't cut back enough. The third thing is storage capacity. Globally, storage capacity is 6.8 billion barrels. Currently, roughly 2/3 of that has been filled up. In the United States, probably more like 3/4 or 4/5 has already been filled up in Cushing, Oklahoma, and elsewhere. So that's really what's driving this. And as you know, most of these future contracts between sellers and buyers don't actually involve the delivery of oil, because most of these are sold again, and this way they avoid taking delivery, because these things cancel out. This time, because of the filling up of all storage capacity, it didn't work out. So you had this unusual phenomenon of negative prices, that you actually have to pay sellers to sellers have to actually pay buyers to take delivery of the stuff. Okay, so Trump says that he'll fire at Iranian gunboats, and the market bounces up. Again, makes no sense at all. So do I have a deep insight? No, thank God. But it is fascinating to watch this. Certainly very, very painful for many countries. Remember, the break even for most shale oil producers is probably more in the region of $50 a barrel. So something like 3 million barrels a day of US shale production could go off market if this persists, because they simply can't support it. Saudi Arabia average is $2.50 per barrel. So they can keep producing for a long time after everybody else has gone bankrupt. but they need the money because they're running a huge fiscal deficit. So that's an issue. Um, North Sea oil also much more expensive to pump. Alberta sands completely gone. They really can't produce at less than $45-50 a barrel. So for most oil producers and anybody investing in the oil company, bad days, really bad days. Uh, the, there are some really interesting articles to look at. If somebody wants to read about why prices went into negative territory, you should look at, there is a blog called Econ Browser, and yesterday's blog on it was about this, and it's two or three pages, and you can just get a bird's eye view of how things happen. The man writing on it is one of the leading authorities on the oil industry. Okay, yeah. Interesting question. Difficult times for oil producers. I used to work on the energy sector a long time ago, but kind of stopped doing that more recently. Okay, if not anything else, let's move on to the financial innovation. This is really a area which is, I feel, really important, really interesting, lots of interesting things happening. One thing to start off with is, what is the focus of research and development, and to what extent is financial innovation something which companies or countries are putting a lot of money in? If you look at overall R&D spending worldwide, between 70 and 75% of it is in the manufacturing sector. So services attract very little by way of formal R&D, the way R&D is accounted for. If you look at what's happening in the financial sector, that's roughly financial in R&D amounts to just about 0.33% of value added in the industry. So an extremely tiny amount of the value added by the financial sector is plowed into R&D. And the average intensity worldwide, I'm just talking about the United States. If you look at it worldwide, it's about 0.42. So less than 0.5% of value added goes into this kind of research. If you take a point of reference, what happens in the manufacturing sector worldwide, roughly 2.1% of value added in manufacturing is plowed into R&D. So as of now, most companies in the financial sector have not been giving all that much attention to research in fintech. So I mean, they've been doing some, but it's not been a great deal. And the ones that are in the lead, China is doing a fair amount. Korea, Japan, the United States, all of these countries are amongst those that are putting a fair amount of money into this. Now, what's the result of this investment? So there's quite a bit of econometric work that has been done on what is the impact of this R&D, financial R&D, on GDP growth. And what you find is that in those countries where financial institutions spend a lot on financial innovation, there seems to be some positive effect on GDP growth. Remember, the people who are doing this research already have a certain point of view, certain mindset. They've already decided that this is probably a good thing. And unfortunately, in econometrics, when you have decided that something is a good thing, you probably find it to be the case, because you somehow do a little bit of selection, you massage the data a bit, you run 4 million regressions, and eventually you find a regression that comports with your beliefs, and ergo you have a published paper. So um, so what you're finding is that the level of innovative activity seems to be correlated with higher rates of growth and higher levels. Both the rate of growth and the level of income seems to be correlated with the amount of research going into financial innovation. Another thing which seems to come out is that, well, let's see, how should I put it? It seems that banks and which adopted financial innovation seemed to be more resilient when it came to coping with crises than others. So you find that financial innovation seemed to have helped banks cope with crises. And the reason would seem to be that these banks had developed techniques for assessing risk, which was much more effective than others, and hence they could anticipate problems coming down the road and take remedial action in time. So, second reason why financial technology or in research in fintech seems to have helped is it made financial institutions that did this more resilient. Okay, another thing that seems to come out is that industries that rely more on external finance and more on R&D activity grow faster in countries where financial institutions spend more on innovation. That's a bit of a mouthful, but what it's saying is that if you have a country where there's a lot of external investment, external financing of investment and R&D activity, and when this is complemented by financial innovation, it kind of, they are sort of mutually reinforcing. So the two things together make a difference. But one other thing that came out from the research, which I found quite interesting, was that financial innovation also makes small and medium-sized banks more fragile. So what happens is that, and you can intuitively see why this is the case, that when banks go too deeply into financial innovation and start using all sorts of risky financial instruments to make their bets, they are more likely to expose themselves. And if you are a large bank, you can absorb the shocks. But if you are a small bank and you've gone too deeply into, sort of risky investments because of the innovation you have done, and something, the market sort of turns against you, you're likely to get into trouble. So, ergo, the lesson from this seems to be, yes, financial innovation may be correlated with growth, but remember, there are many other determinants of growth. But let's say financial innovation seems to be. Financial innovation is most effective when it complements research and investment in other areas. So that, again, intuitively, you can see why. Financial innovation means that the banking system can provide more financing for sort of risky activities in other areas with potentially high returns. And then thirdly, the financial innovation seems to be most advantageous when you are a large institution, because some of the innovation is going to get you into trouble. And if you are a small bank, you're likely to keel over. But if you're a large bank, yes, you can take some of the hits and still survive and continue going ahead. So that seems to be the sort of the major findings coming out. Again, let me say that I'm pretty agnostic about some of this research because I read hundreds of papers on sources of growth. and everybody finds some variable out there which they think really makes a difference, and they plug it in. But if you go through the literature, there are scores of variables, governance related variables, R&D, investment, human capital, intangible capital, you name it, they're out there, managerial skills, all of which seems to have some effect on GDP growth. But when you step back and just say, look at the financial sector and say, how much does financial innovation alone contribute to GDP growth? My sense is it's probably minuscule. The contribution is probably really small. But if you're only reading the literature on the financial sector, you're likely to be coming away feeling that this is really what matters. So, typical of economists, depending on which silo you are in, you believe that your silo makes the most contribution to GDP. Okay, let's look at what about
Professor,
the. Yes, sir.
can I ask a question? Yeah, so my question is basically, when we're talking about financial innovation, is that like products, methods, all of the above? How exactly is that defined?
Okay, financial innovation, it takes a number of forms, and so some of it is something like application programming interfaces, use of artificial intelligence, use of machine learning, biometric identification techniques for authentication, cloud computing, artificial intelligence, the works. So that's one part of it. The other part of it is the many derivative type instruments that you develop. So many different ways in which you can raise money. For instance, we talked about WIMPs. WIMPs is also a kind of innovation. We talked about many others which banks has introduced. All of those are seen as innovation. And then you have physical innovation. ATM machines was one of the greatest innovations. So there's a kind of a range from hardware to various kinds of software to various kinds of financial instruments which are used for various purposes. And then you can also think, and which we'll talk about, which is what we're talking about, different organizational forms, such as these fintech companies that have emerged out of the blue that are not like banks, but are different, which are also a kind of innovation. Okay, so it's a pretty expansive term and covers a lot of terrain. Okay, so as I said, what explains the rise of fintech? Really, it has to do with the internet, and it has to do with the many things that internet has allowed to expand. And I mentioned these things like AI and machine learning and cloud computing and big data. All of these seem to be amongst the important factors explaining the rise of fintech. The other interesting thing is that, by the way, stop me at any time if you have a question. The other thing is that most of fintech seems to have emerged as a result of new entrants, from new startup activities, new firms that have appeared, that have started offering these new kinds of services or relatively new services as a challenge to the banks. So when you look at the literature, you find that the amount of fintech related innovation by banks, by standard commercial banks and other investment banks, has been relatively small. They have developed a lot of products, which investment banks and so on, to raise money or to make more riskier kinds of investments, but they have not been at the forefront of fintech the way Alibaba has been, or Tencent has been, or these others have been. So I think that's a really important thing. It is one consequence of startup activity, and importantly, so that's sort of one. Just give you a couple of numbers. 27% uh, of, of, uh, of the unicorns that have emerged through 2019 have been fintech startups, and with valuations that are exceeding $1 billion. So if you look at the total spectrum of startup activity, large unicorn startup activity, fintech seems to loom very large. So it's been quite a significant part of this sort of upsurge of activity in the recent past. 9 of these unicorns are Chinese, and 14 of the unicorns have been American ones. The largest of all is, of course, Ant Financial. Um, and the others are further down the list. Okay, one of the reasons why they have these startups have been so successful uh, as fintechs is because they have been able to marshal and analyze big data. So one of their signal advantages comes from their ability to harvest enormous amounts of data and to then use this data for the purposes of lending activities. So one, they're firms, these companies that have started up this whole fintech boom have been new companies, startups. They have been very large ones, and they have been ones that have used, gathered, and utilized big data with all that goes with it. Okay, why has big data been so helpful for the purposes and data analysis? So it's not just big data, but data analysis that goes with it that makes the difference. So why should it matter? Ben, were you raising your hand? Yeah.
Yeah, because I think one of the reading mentions about the big data can help company find out the customers' experience in using the services, and especially and also that's not part of the reading, but I recall people saying for the general public service, it can better generalize the pattern of how people utilize those services. So yeah.
Yeah, that's true. Anyone else have a thought on this?
I mean, I think in general, and we've talked about in this class specifically with China, there's the issue for lenders of knowing who to lend money to and sort of the lack of information about those potential customers. And so the goal of big data is to gather all of that information that's possibly out there to try to use that to be smarter about who you lend to.
Right. So what's happening is that the banks have not only got this vast amount of data, these startups have got this vast amount of data, but they've also been able to use statistical techniques very effectively in order to get credit scores on potential customers. So, by observing a range of activities of these customers, which can now be tracked using all the techniques that are available, they can figure out they can put these people in various risk classes. And by being able to put them in risk classes, they can exactly differentiate and tailor their lending so as to get the maximum amount of profit and to minimize the risk that they face in lending to a diverse range of customers. So, and by the way, it seems that the internal credit scores, which these very large entities have been able to generate, are frequently much better than the credit scores that you get from rating agencies. So remember, there are out there in China, in the United States, in every country, there are credit bureaus, rating agencies, which have been collecting data on all of us for a long time. And the banks utilize these credit data from these bureaus to determine what the sort of risk rating of customers is. But now with this technology, the internal capacity is so much more effective. So what it says to me is credit bureaus either go out of business or they really only end up servicing the smaller banks who do not have this in-house capacity. Okay, so what is the sort of advantages which you see coming from the rise of this fintech sector? So what do you see as the, okay, growing now? Is it a good thing or not such a good thing? If it's a good thing, what do you feel is the good stuff that comes out of this? Katrina, you're going to go
Well,
ahead.
I was going to say, that's such a broad category. Like what aspect?
We're talking about just looking at the contribution that this fintech sector is making to finance, to financial development of the economy and potentially to its growth rates. Again, we're looking at it just from the financial angle, financial sector angle. Why is it a good thing?
Well, I think if we look at other countries, for example, one of the good things about fintech is that it is providing credit to the bottom half of the pyramid that historically has been unbanked and there hasn't been a lot of credit. So if you think about M-Pesa in Kenya, for example, the velocity of money is sped up tremendously because people without bank accounts can now actually start purchasing on credit. So it can be beneficial. It could also lead to some risks down the line, though.
Right. So I think one is that it's making finance more inclusive, as they say. So the important thing is it enables the financial system, now broadly defined to include these new entities. The financial system now services a lot of people previously unbanked, previously had no access to credit, etc. So that's one of the advantages. What else?
It definitely cut back the transaction cost, especially in terms of like daily economic activities, and sort of stimulate the consumer consumption in Chinese economy.
Okay, so the way I sort of phrase it is that it increases the efficiency, both the scale and the efficiency of transactions. So financial transactions are made much more effective, efficient, because now you have the benefits that can be derived from this new technology. This new technology makes payment systems, everything else, a lot more efficient and seamless. Okay, there's further stuff, one or two other things that I think you should be thinking about. So you've got these newcomers coming into, edging their way, elbowing their way into what used to be a kind of a closed garden. What happens when that happens? Shinzo, you never say anything. Speak. Yeah. Ben, I can just see the top of your head. Hi.
Yeah, so I've been thinking, yes, it can use stats skill to generate the potential customers' behavior, but how would it tell us about the behavior of customers of a wealth management projects, those wealthy people? Because I think during my previous internship, when it comes to those people, we still gotta do know the customers, those standard procedures, not using those specific skills. So I'm wondering how do we connect that to the wealthy customers?
Oh, so you mean how can you better serve or assess the risks of wealthy customers?
I guess to use the word serve is much helpful in the sense that because they are more unique, unlike the regular customers.
I think for the very rich, these kinds of techniques are probably less useful. Their the standard relational banking really matters. Getting to know your customer, getting very wealthy customers, I think is a lot more important. And I believe that requires more of a face-to-face or other sort of human-centric relationships, and not trying to, grind through a lot of data to determine how these people will behave. That would be my thought. I don't think it makes a lot of difference to the relations or lending to the very rich or borrowing from the very rich. Anybody else thoughts? Yeah.
I mean, I will also, I guess, say just sort of in general, the benefit in terms of, I mean, regardless of, for the very rich or not, the benefit is also lending in a smarter way, because regardless of sort of whether the person has maybe a long like banking history or not, they allow you to about, sort of financially what the potential customer has been up to, or what your customer has been up to throughout the entire world, in a way that, you could not get like 50 years ago or even a couple decades ago. So that's sort of the benefit, is also like, not just lending to more people or providing finance to more people or more companies, but also doing so in a smarter way.
Okay. So the quality of lending improves, or you lend, as you said, you lend smarter. And by lending smarter, you presumably improve the bottom line of the bank. And perhaps by lending smarter, you're also helping your customers. You're tailoring your product more or less precisely to the needs of the customer. So actually, the way I'd sort of put it is that not only are you more efficient, you're providing a wider range of products. So one of the advantages of fintechs is you've broadened the spectrum of products that you're making available to your customer base. And this is from the lowest to the highest income groups. And I think the one thing which you haven't touched upon yet is competition. Remember, by introducing a range of new players into the market, you increase the competitive pressure on existing players, the existing bank, commercial banks, investment banks, anybody else who's been, traditionally involved in this activity now has to factor in the pressure and competition from an entirely new set of players who are coming in with new sets of rules, new instruments, new technologies. So that was, now, having said that, what's the difference between a traditional bank and a fintech lender? Are they different? Are they the same? I mean, so I try and identify in what respects they are the same or provide essentially the same service, and what ways are they different?
So I'd imagine the backup from the government, if something were to go bad, is different between the two.
Yeah. Okay. So one of the things is that since these are not registered, licensed banking institutions, they don't have the backstop. And we've talked about the backstop in the past, which a commercial bank has, and the sort of the insurance of the deposits that a commercial bank has. But remember, these are not deposit-taking institutions. Okay, so there is a difference here. These are not a standard bank that you have demand deposits and so on. But nevertheless, yes, they do not have that sort of a backstop from the central bank. Okay, what else? Anyone?
I guess in the case of China, like fintech lenders are less regulated, and the government, like policymaker, are generally having like less understanding of what's happening in the industry. So you see a lot of fraud or just like finance crime happening or emerging because of the fintech developments.
So that is the
like the P2P issues, etc. Yeah.
No, I'm sorry, I'm not getting. So what's the point? What's the difference?
So I'm just saying that like a lot of like fintech
Yeah.
lenders in China are actually like because they're less regulated and they use their like advanced knowledge to carry out like financial crimes or like fraud and like not operate in a like, sustainable way.
Right. Right. Actually, one of the things you have to look at is, we talked about banks to maturity transformation. Recall? Do these institutions do maturity transformation? Because that's one of the key, factors differentiating banks from anybody else. And in this case, these entities generally do not do maturity transformation. They actually match, as in the P2P case, match savers with borrowers. So I'm, whoever, I have $100, I want to invest. In a bank, I put it in the bank, and through the fractional reserve system, the bank might invest in something which has a maturity of 20 years. But in this particular case, there would be an exact matching with a borrower. So there's no maturity transformation being done in this case. Third thing.
Could I ask a question?
Yeah.
Yeah.
Sure.
And this is partially because of my unfamiliarity with this. Like, it sounds like when we're talking about fintech innovations and the benefits, it's very much on the like on a personal, like a diversification of personal products, right? It increases individual access to financing. And I'm thinking about, how 20-25% of firms in China report inadequate access to financing as a major constraint on growth. Are the benefits of fintech that we're talking about equally applicable to small and medium enterprises?
Yes, and in fact, those are the enterprises through P2P lending in particular who stand to benefit the most. That is, many of these had previously no access to banks because they didn't have sufficient collateral, or there wasn't enough of a track record or information about their past that the banks had that would allow them to lend to these. But in this case, the P2P lending, and which is why I'm mentioning this thing about maturity transformation, there is the saver knows how much what period he is lending to the borrower. So there's the P2P institution only brings borrowers together with lenders. Okay, so and that's how the small investors, the small company that is looking for funds gets this money without having to come up with collateral. The other related thing is that the difference between the banks and the fintech type of lenders is that they don't rely on long-term relationships. One of the ways in which smaller banks still can lend to small companies is because they operate in a, let's say, a small area within a small city or within a small region. And over a period of time, they get to know the companies in that particular area. They know them by reputation. They know them through other firms who deal with these companies. And eventually they build up a roster of knowledge about these. And this knowledge, these sort of personalized relationships, enable them to service some of these companies. Now, that's how many banks, or particularly the small and medium-sized banks, operate long-term relationships with customers. But the fintech ones are not doing that way. They're depending on big data. They are not trying to build up or understand or get to know people over the long term. They're going to use just this huge amount of data and crunching the data in order to determine whether it's worth lending to somebody or not. So again, one of the areas of difference. Yes, Ben?
So there's no future about the RCCs, right? Because we can just rely on big companies to get data from potential farmers and households, and just give them the money. There's no need to set up county level.
Yeah, I guess Yeah, if you're an RCC and you're lending to a whole bunch of farmers and you're lending in a local area, um, yeah, I guess you could be pushed aside by a fintech lender who has a lot of data on whatever is happening to climate, to farms, to water supplies, all of these things, and can statistically determine the credit worthiness of every farmer in that area. Uses satellite technology, figures out what soil quality is like, and you can precisely say this guy is going to produce X pounds of grain in the particular year, and then decide to lend him. The only thing you don't know is what is the sort of moral code by which this person operates. That's the only thing you don't know. Can't get inside the person's head, but you can figure out what the person can produce. Yeah. Okay. Yeah.
Can I say something?
Sure.
So I think one major difference is an advantage we haven't covered, and that's one of the major topic of my paper, is that a lot of these fintech companies come with a complete set of financial and personal ecosystems, such as Alibaba came with this Taobao and all this kind of Alipay and all this kind of ecosystem covering the customers. So my feeling is there's a much stronger chance for the company to promote its product and to cross-sell its product on these platforms, and that kind of give them an edge in the competition with traditional banks.
That's quite right, and we'll talk a little bit more about that down the road. But you're right that cross-selling is much easier, and that many of these fintech companies have become pretty diversified by getting into, as you said, insurance, in other activities, in fact, medical care. So they have entered in from the financial side, but because of their many other activities, they are able to diversify to an extent that banks have been unable to. But banks are also scrambling to keep up with these companies and entering into partnerships with other types of firms so that they can offer the same sort of diversified set of products which the fintech companies are doing. Okay, Hanchen, are you there? Can you please turn on your video? Okay. What are the similarities or differences do you see? One other important one is anybody? Emily, anybody figure out there's one other kind of important thing which okay, what is it? The thing is that the fintech companies cannot offer the sort of diversified investment opportunities that banks can. And the reason is that, for the banks, in order to offer these diversified investment opportunities for investment banks and others, is they have to keep some of the risk on their books. That is, they have to take some of the risk, underwrite some of the risk, so as to benefit from this liquidity transformation. Remember, as I said, banks go through both a maturity and a liquidity transformation. But in order to do that, they have to absorb some of the risk. The fintech lenders are doing none of that. The fintech lenders are just matching savers with investors. They are not doing the rest of the things that the various kinds of banking sector institutions do. So in some ways, they are offering more to various borrowers, and particularly to the smaller borrowers. In some cases, they're still offering less by way of diversified investment opportunities than the banks do. And by banks, I'm including many of the shadow banking operations that are linked to the banks and which we have talked about. So that itself is a large ecosystem of its own. And as you pointed out, the fintech lenders have come now with their own ecosystem, and both these ecosystems are now kind of likely to merge with one another over time. Okay. One of the things I found is that in which the fintech companies are doing somewhat better is payment systems. So the fintech, and all of you I'm sure have used them, the fintech companies' payment systems are a lot more convenient and efficient. So, you go and show your phone to some merchant and a transaction is kind of seamlessly done. But with the banking system, it is a little bit more complicated. If you write a check or you make any other transaction, it has to go through a clearing system. It may take a day or two and so on. So the payment systems being offered by the new companies are, let's say, a lot more efficient and quicker than the ones being offered by the banks. Also, what is happening is that banks have entered into various kinds of arrangements with these fintech companies, because as you know, if you're using many of these fintech payment systems, they are linked either to a bank account or to your credit card. So the banks are to some extent involved in these payment systems. But the fact that the banks are allied with the new fintech companies also means that some banks allow the fintech companies access to customer data. So in addition to gathering data from their other sources through whatever their provision of other mobile services, banks allow these companies to scrape, as they say, customer data from the banking system. So that provides these characters with yet another source of information. And presumably the banks get a payback because their payment systems are interconnected with the fintech companies. Okay. So I don't know how many things we covered, but all of these things differentiate the two types of providers. All right. Any questions? I'm still wondering why Han Cheng is not. Han Cheng, can you turn on your video? Are you there? By the way, does anyone know Han Cheng?
I think he's just auditing this class.
Yeah, but is he in town or is he in China?
I think he's in the US.
He is in the US? Okay. Yeah, I mean, I see somebody appearing. Yes, he has appeared. Hi, Han Cheng. Hello. Okay. All right. Let's come to now fintech in China. All right. Let me give you the narrow definition of China's digital economy and then the broad definition. So the narrow definition refers to the ICT sector, including telecommunications, internet services, hardware, and software. So that's the narrow definition. The broad definition includes the ICT sector, parts of the traditional sector, and all sorts of integrated and digital technology related activities. So covers a whole lot of things. I understand. My own sense is that the narrow definition makes more sense to me. The broad covers too many other things, which I feel are probably peripheral to the digital economy. Katerina, you were going, no, okay. All right, according to the narrow definition of the digital economy, about 6 to 7% of China's GDP falls into that category. This is about a year, or this is a 2018 number. It may have increased marginally since. Just to give you a point of reference, in the US and Korea, it's between 8 and 10%. So if you take the narrow definition, China 6 to 7%, US 8 to 10%. And because it is only about 8 to 10% in the US, which makes people doubt that whatever happens in the digital economy, whether it's in this country or in China, is going to make a huge difference to GDP growth. And it's one of the reasons why you have not seen much increase in total factor productivity growth, whether in the US, in Korea, in Japan, or in China. It's because the tail is still a little too small to wag this dog. And even if there's wonderful things happening in the digital economy, it's simply not big enough to make a big difference to productivity growth. All right. If you go by the broad, sorry.
Can I ask, how do you typically measure total factor productivity? Is it just a residual term?
It's a residual. So you
look at the
net out,
labor, and then whatever's left over is you assign it to TFP.
Okay. Yeah. This, as you know, is a highly contested area with more papers than anything else you can think of, trying to say, how do you get to TFP, and is it are the means of estimations being used reliable? But for what it's worth, and a huge number of people have devoted time to this, we have some numbers of TFP, and it does seem it has been growing slowly. And the growth has been slowing over the last 20 years. Okay, by the broad definition, the digital share of China's GDP was about 15% in 2008. And as of 10 years later, the estimate is about 30% of GDP. But then, if you use the same criteria to measure the digital economy in the United States or in Japan, it's 59% in the United States and 46% in Japan. So to me, those numbers are just way, way too high. So my own preference is to go with the narrow definition. And the narrow definition, as I say, jives with my understanding of how much it is contributing to growth and productivity in any of these countries. Again, by the broad definition, roughly 20% of the GDP in a Brazil or a South Africa falls into the digital economy. Okay. We're at 3. Shall we take 10 minutes off, and then we'll come back and talk about all of the good things that have come out of fintech development in China? Okay, so take maybe 10 minutes and then we get back to work. Okay. Oh, I see Ben too isn't here today. What's happened? Have you, do you know where he is? Okay, he communicated with me the other day, but all right, okay. Any other news coming out of SAIS? I mean, you heard that Andy Murtha is going to replace Calder. I hope I'm not giving away any.
Oh, I'm sorry.
No, I didn't. No, you didn't hear me. Yeah. Okay, these are just some facts that I think you need to store away. One is in terms of mobile payments, China now accounts for 40% of global e-commerce transactions, and 15% of transactions are now online. That figure probably has gone up. This is a 2018, 2019 figure. So I'm assuming that, it's more like 17, 16, 17% of all commercial transactions in China are now online. In the US, it's about 10%. And that's a recent figure. So even
Sorry, what was the first figure you said?
The first figure was 15% of Chinese retail transactions are online, and it's about 10% for the United States. And I'm thinking, given what's this sort of turmoil that is taking place, that both of these have probably increased a little bit, but probably not by much. So we're talking about maybe 1 percentage point increase. This has always surprised me that how little of the retail activity in the US is done online. I mean, the way what it seems is that everything is online, but in actual fact, it's a fairly small fraction. Many companies are now offering digital wallets, and we'll talk a bit more about those later. The other thing to look at is that Chinese companies are amongst the most globally innovative. They have 5 of the 10 slots in the KPMG ranking of top fintech firms in 2017. So 5 of the 10 top slots in the fintech company ranking went to Chinese firms. But if you look at the World Bank's digital adoption index this is a bit dated. It's 2017. China ranks 50th out of 131 countries in terms of its digital adoption. So to me, that's all. It seems a bit counterintuitive. I mean, but then you have to remember that China's urbanization rate is only 56% at this point. So this is still a huge non-urban part of the Chinese economy. That may explain why the ranking is 50th. And it's 59th out of 139 countries in the World Economic Forum Index as well for digital adoption. So even though at one level it seems to be a country that has moved very rapidly into the digital environment, it still seems to be lagging behind some of the others in this regard. Growth of this fintech activity, financial services activity, has been extraordinarily rapid in the last 8 or 9 years. And one of Alibaba's money market funds, it's I think called Yue Bao. Did I get that right? Right. Okay, great. All right. Yue Bao is now the largest money market fund in the world. So it's gone beyond the JP Morgan fund and others. So huge increase in fintech related activities. China is also now the global leader in online lending. It has roughly 3/4 of the global market in online lending. And there are a variety of participants. I mentioned the Yue Bao. There's also one called Li Kai Tong. This is one with Tencent, Li Kai Tong, right? And there's one from Baidu called Baifa. So these three are the sort of in the forefront. These are the sort of pace setters for China's money market industry. China is also, I guess, well in the lead in terms of peer-to-peer lending, which connects various lenders with borrowers. There's a bunch of market leaders. You should remember a few of the names. One is called Lufax. It's from Ping An Insurance. There's one called Yirendai, something called Creditease. And then there are a bunch of others, Rendai, Zai Kai Bao from Alibaba, Dianrong, etc., etc. So just remember a couple of these names as amongst the principal P2P lender institutions. The number of P2P institutions just sort of mushroomed, so went into about 3,000 in 2015 and so on. Another area where China has moved into the lead following the emergence of fintech activities is venture capital financing. So there's been an enormous compound rate of growth from 2014 to 2017, the amount increased by 300%. At least in that year, it overtook, in 2017, the United States as the largest provider of venture capital financing. Roughly 47% of global, Yun Shinzo. Hi, Shinzo, you had something to say?
No.
Oh, okay. I thought you waved, so I thought you were waving at me. All right. So 47% of global fintech investments were in China. So huge increase in overall venture capital financing, and also a big increase in financing for fintech. And much of this went to the usual things. It went for digital technologies of various kinds, virtual reality, robotics, blah, blah, etc. Okay, another area where China has put in a huge amount of money is cloud computing. Alibaba has set up numerous centers within China and outside China. The spending has grown enormously, 400% and so on. You don't need to remember all these various numbers. Just keep in mind that these are the various areas in which this fintech activity is sort of spreading its tentacles. So then, all right. But then when it comes to how is it having an effect on productivity and growth? I mean, I always circle back to that. I mean, all of these nice things, they have to impact on the bottom line. If they are not impacting on the bottom line, and to me the bottom line is GDP growth or productivity, then I begin to wonder whether we should take everything as seriously as we do. And if you look at some of the literature which tries to track how investment in digital technologies is affecting GDP growth, you find that there is a considerable correlation. One of the results shows that a 1 percentage point increase in overall digitalization of the economy is associated with a 0.3 percentage point growth of GDP. So 1 percentage point of increase in digitalization, 0.3% increase in GDP growth. Likewise, people like Jorgensen and others continue to find that investment in IT capital, IT-related capital, seems to be closely correlated with GDP growth. This is not the last word on the subject. Others find different outcomes, but let's put it this way. There is a reasonable presumption that this investment going into digital technologies, digitization, is probably going to have and is having some modest effect on growth and total factor productivity. We are not seeing as much as we expected. The expectations are much higher, but certainly it must be creeping in. The counterfactual is, suppose none of this had happened. Would we still be seeing 6% growth of the Chinese economy? Would we still be seeing 2.8% growth of the US economy? That's the sort of counterfactual. And maybe my own gut instinct would be probably not. We'd probably have lost 0.5 percentage point of GDP growth of the US economy, and maybe 1% or more growth. But this is entirely just a sort of a guesstimate on my part, based on my sense of how innovative these technologies are. Okay, so now comes the big question. Why did fintech grow so fast in China? All right, so lots of reasons. Tell me.
I mean, one classic reason, I guess you could say, is that comes up a lot in terms of why tech development happens one place versus another. There weren't sort of decades of the traditional financial infrastructure or framework that, say, the US or Europe had. So it's sort of easier to transition because it's less of a transition.
Okay, so one of the important reasons was that you didn't have the traditional banking and credit card infrastructure in China, so which has become very deep-rooted here. And so there's a large segment of the population that was unbanked. There's a large percentage of the population that did not use any kind of instrument such as a credit card. So that's definitely one major factor. Okay, what else?
I'd say also the fact that so many of these companies just have so much data that a lot of companies in the US might not have the same amount of, or aren't necessarily allowed to mobilize in the same way.
Okay, so another thing could be that you had the emergence of large companies in startup activities actually in China that accumulated vast stores of data through other activities, not fintech related, other activities, and that this data could then be leveraged to make it possible for them to enter into fintech activity. All right, that's second point. What else do you think? What are the sort of obvious things you haven't said? What's the sort of big elephant? Digitally active population. You have to remember that the spread of the internet, the use of mobile devices in China has been absolutely explosive. And in part, this is because you have companies that are making available these mobile devices at very low costs. So the fact that you can buy these smartphones or relatively smartphones at extremely low prices has meant that an enormous segment of the population is now has a usable mobile device, and as also has internet access. So the digitally active, important thing is the digitally active population in China, which is a large number now. I believe it's 700 to 800 million people. 69% of them are somehow taking advantage of fintech, P2P lending, online payment services, whatever they're making use of it. By comparison, roughly 52% of a much smaller digitally active population in India is making similar use of fintech. By the way, it's only 33% in the US. So, because as you mentioned, Katerina, because there's an already existing infrastructure of sorts, a far smaller percentage in the US find it advantageous to use these services. So, I would just so mobile internet and so forth, all of these things, social media savvy population, all of these things made it possible for. Now, one other thing, okay, but go on. Yeah, Emily, you know, suddenly yeah, go ahead.
I think well, I used to live in a underdevelopment regions in China for a while. So I think a lot of people in underdevelopment places they're underserved for the banking services. So a lot of the people in rural places they don't even have a bank account. But because of the apps, the very easily developed apps and the popularity of smartphones and also the popularity of the e-commerce, they enable a lot of underdeveloped people to use fintech to enjoy this kind of financial services.
Right, exactly. And because of the ease of use, because people have gotten accustomed to using these smartphones and using the simple apps, and the apps have become far more user friendly, it makes it possible for people who are in rural areas and have no bank accounts and very little contact with banking institutions. They can actually get use these as well. You find this also in many other countries, Bangladesh, Pakistan, and elsewhere, that people, and Kenya, for example, with M-Pesa, that people are using these to remit money, to settle payments, and people who have, many of whom are illiterate, and but still somehow manage to utilize the technologies very efficiently. Okay,
Professor, do Make in China 2025 actually help this?
I don't know. I mean, when it comes to producing some of the gear needed, the sort of the telecommunications infrastructure needed by companies like Huawei or ZTE, I mean, those companies were already very active in this particular area. When it comes to making smartphones or any other mobile devices, I don't think Make in China 2025 made a lot of difference to those. Make in China 2025 is focused on a lot of other high-tech activities, aircraft and satellite technology and quantum computing and all of those things. So my feeling is that as far as fintech development is concerned, Make in China 2025, which really kind of gathered momentum after 2015, may have not made a lot of difference just to the fintech. So I'm not saying to any other part of the Chinese economy. Okay.
I have a question just off of that. What about like pushes for things like cloud computing that do have sort of a cross, like that's used in smart city infrastructure as well as fintech? Do you think there's some crossover there?
On cloud computing, again, there, as I see it, the advances are in server technology and in various other kinds of software that is used to, store and utilize this. There is a lot of technology going into minimizing energy use there and cooling servers and so on. But I didn't think that cloud computing was making a big difference, or advances in technology in cloud computing were affected by Make in China. I think that they're ongoing on their own volition without requiring any push from this particular policy. Where I do think this whole telecommunications may make a big difference is in autonomous vehicle use and factory 4.4 type of thing, because that's where fifth generation 5G will make a big difference to the use of the Internet of Things. But it's not, again, it's, I think, a little bit separate from. Now, one other area where you may be right is quantum computing. Quantum computing will do two things. One, further speed up the whole process of data processing and payment processing and so on. And at the same time, it will make hacking or intrusion of any kind far harder. So that will help secure things. Third area is blockchain. There, yes, further research in that area, but again, and to some extent that is supported by China 2025, emphasis on blockchain may make for a more efficient and secure payment system. Okay, so something to think about. Okay, what other factors have contributed to the spread of fintech? So we've named a few. How about some more? Debit cards.
Okay, sorry.
Go ahead, Mo.
I was thinking about something else. Actually, it's not really relative to financial things. I mean, from my perspective, I used to talk to some friends in Renendai. So I think most of the fintechs, they use a different strategy to branding. I mean, they are really good at selling products. So in China, we can see their like advertisement everywhere. Yeah, actually, in very popular TV series and even in the rural countries, you can see their like advertisement on the wall. They print the wall, so the people, they can't connect it into the internet also can see their like advertisement and encourage them to use this kind of product. So I mean, from my perspective, I think their selling strategy and branding or marketing strategy is a crucial part to become to let them become very popular in China.
Oh, okay.
Yeah.
All right. I had no idea. So, yeah. All right. So please take that on board. Marketing and very effective marketing, tremendous outreach, and penetration into the very corners of the economy has made it possible for them to popularize the services and to make people aware of these services. And also, as I said, since the services are easy to access, many more people are willing to utilize them. Okay, great. Right. Yes. What else? Tell me about, I mean, China didn't have a credit card culture, but it had a fairly high circulation of debit cards. And the debit card system permitted a more easy transition into the use of other means, mobile mobile communication-based modes of payment processing. So the two kind of fit together very well. The debit card system could feed into the mobile communications, provide a link with the bank, and establish a payments mechanism. So one thing, as Katerina mentioned, there was an underdeveloped banking system in terms of access. There was an underdeveloped credit card and so forth and check cashing system, but a developed debit card system, a more developed debit card system. Okay, what else? What's the thing which sort of facilitates all these transactions in which China took a lead? So in payments transaction, there's something which you do in China all the time that.
QR codes?
Yeah, QR codes. Those have been around for a while, but China took the lead in introducing them. And one of the reasons why QR codes are so helpful is that unlike other barcodes, they can store a lot more information. And so by storing more information, they make it much easier to consummate these kinds of simple transactions that you can do without needing a POS, a point of source type of a terminal. So again, you didn't have the POS infrastructure in China at every sort of retail outlet. And the QR code essentially leapfrogged over that. Now you don't need that system to be installed, which you have when you go to a store here. You guys swipes your card and so forth.
Professor,
yeah.
I think another point may be that so basically in the US, if you go to like quick transaction between the households and the businesses, there is a problem that like there could be like a different kind of business cards, different kind of credit cards, and that make the transaction more difficult. But in the case of China, I feel like because Tencent and Alibaba has such a strong monopoly in the industry, basically everybody can have, everybody have a Tencent or Alibaba finance account, and that makes transaction much more easier because everybody are in the same platform and use the same topic, the same thing.
Right. I have faced that. Mo, you had something to add to this? Mo? No? Okay. Yeah, well, actually, I faced that when I tried to use my Amex card in places. So, the Visa card or whatever is accepted more or less everywhere. But as you pointed out, your card may not be accepted in every place. Some people may want something, some people may want another because of the cost of the transaction. Whereas in China, the two companies kind of dominate the field. I guess Union Card is another. Does most people or many people have a Union Card as well? Right? I mean, that's pretty widely accepted in China, if I remember correctly. But so just the very few of the payment systems, because of their almost universal use, yes, certainly facilitate the employment of this technology. Okay. Any other thoughts? Any other things that? Okay, one of the things which is related to this, which is related to, is the low cost to merchants from adopting this. Remember, we talked about this POS technology. Well, you don't need a terminal, and the fact that any merchant can utilize this, the low cost. So the entry barrier into using these payment systems is very, very low. And hence there's been this massive conversion. And the conversion has not just been in the larger retail establishment, it's across the board. As you know, anybody sitting by the roadside in China selling something is willing to accept it. Taxi drivers are willing to, and so on. So low cost of the technology. There's one other sort of important thing which enabled or permitted, let me say, permitted the rapid expansion of this, of fintech? What do you, I mean, think back. I mean, we've covered this ground somewhat in the past. Rack your brains. What allows something to appear and just grow suddenly in a country, especially in a China?
Like, I guess demand from PBOC or
go on.
CBRC.
Yeah.
Yeah,
I think it's
what?
how to say it? It's a well. First, it's a new thing. When it comes out, it's a new thing. So we don't have like a follow-up regulation. So they have kind of a free space to grow up in the first place. And then when the regulation comes out, it follows up. Now it's hard to enter this kind of market. It's kind of harder to enter in this kind of market now.
Okay, so light regulation seemed to have been really important. That there are two things. So one is that Chinese regulators, they were not sort of caught off guard, but they took a very sort of a light-handed approach to regulating this. They, in fact, encouraged the emergence of these new technologies in China. It's the same thing in India, that the growth of the IT industry in India happened in part because regulators were, one, asleep, or two, actually didn't aggressively intervene to regulate and perhaps even stifle the growth of the industry. There is a school of thought, as you know, from the Chicago School in the United States, and exemplified by Philippon, who's now on chair of economic CEA in the White House, that one of the reasons why technology does not flourish, or at least doesn't, deliver on its promise, is because of excessive regulation. And it's excessive regulation that may kill off autonomous vehicles, that may kill off blockchain, that may kill off digital technologies, all of these things. But in the Chinese case, fintech emerged because regulation was easy and the government was broadly supportive of this. The second thing, and related, is that the Chinese consuming public seems to be willing to experiment with new technologies very readily, perhaps more so than in other countries where the consuming public can be more conservative. And the third related reason is there's a massive expansion of China's middle class. So people in the middle class income range with some discretionary income were much readier to try and experiment with these technologies and exploit these new technologies. So we've got, I guess, three things there. Light regulation, what did I say? Middle class and readiness to experiment. All of those three things combined, rapid growth.
Professor, but did the current vacuum of regulation of this field, especially online loan and online money lending, would that stifle public confidence on this field? Because there's a lot of financial crimes on this.
Yeah, I mean, and I'll come to regulation. That period of regulatory laxity, you might call it, or light regulation has passed. That came and went, and now there is a lot more regulation. And I'll go through a list of the sorts of regulations that have been introduced in a little bit. So yeah, that's over. But with as soon as an industry becomes large enough, and as soon as scams, which inevitably show up, appear, then things, regulators move in. Yeah, Jenny?
First, I feel that this light regulation depended on who was an initiator of this segments reform. So for digital payments, it was Tencent and Alibaba who was deeply trusted by the government, have a good relationship with policymakers, and also regulators were much easier to track all the transactions, etc. So there was confidence beyond Beijing policymakers, seeing that even we give a try, and there won't be that much risk. But in terms of blockchain or other fintechs which were initiated or pushed by smaller firm or new emerging firms. Like we have seen policymakers in China taking a more cautious position.
Yeah, I guess you're right that in the case of fintech, because the BAT group were the ones very much in the lead and dominating the market from pretty much from the very start, and the fact that these are not part of the state-owned enterprise system, but very closely allied with the government and therefore subject to a lot of influence by the government. The government essentially was willing to allow these companies to proceed without sort of hamstringing them with a variety of regulations. But at the same time, even as they grew, thousands of P2P lenders appeared. And once those appeared and the scams started to multiply, I guess the government was forced to move in. So within the large umbrella created by the BAT system, many other things happened and flourished, and some of those were not acceptable to the government. But you're right that the fact that the leadership of the ones in the lead were these major firms probably meant that the government was a lot more comfortable with them introducing these innovations. Okay, sorry, did someone else have a hand up? Mo? No. Okay. All right. One of the things which I think one should be mentioning is, and I think someone mentioned it earlier on, was the embedding of many other services. So what has happened is that they started out by providing basically payment services. But as Mo and others have said, these companies have very quickly branched out into other products as well. And this seems to me to be, what any profit maximizing firm would try and do. Remember, the margins on all of these is fairly low. And the reason in part is because the fintech companies have to work with the banking system. So essentially any benefits they derive have to be shared with the banking system thus far in the payment system. Till such time as they can decouple their payment system from the banking system, they still have to work with the banks. So the margins are pretty low. So what these companies do is to go from selling payment services to getting into everything else. And the fact that they are so massively diversified makes it easier for them to do so. So what they have gotten into is, of course, transportation, dining, medical services, insurance payments, insurance services, wealth management services, virtually anything you can think of, they are now trying to offer using the entry point provided by the payment system to reach a vast number of consumers. So soon as consumers become comfortable with using one kind of service, they are being offered many other services as well. So, I mean, there's a long list of various online brokers and other providers of services. In fact, the People's Insurance Company of China offers stuff, Ping An offers. So the interesting thing to me is that you start out with these companies like Ant Financial offering these services. But once other companies like the insurance companies and the brokerage houses see that, you can offer services through an online system, they also come in as well. So the field is expanding from exclusive fintech type of companies to include many others. And as we'll talk later, the banks have started to diversify as well. Because remember, they are all under competitive pressure now. So the competitive pressure from these fintech companies on insurance companies, on banks, on everybody else, the brokerage houses, forces them to do more or less what these people are doing and to do it in the same way online. Because now they see that customers can be hooked through these online advertising. So it's a, as Tarzan would say, it's a jungle out there. Okay. Now we come to regulation. So inevitably, things started to go a little bit out of hand, or the system became so big and so important and so consequential for the economy that regulators have to move in. Regulators are always there, sort of licking their chops, waiting for for something to happen, and then they're in there. So lots of scams. P2P lenders failed. There's one famous one called Izubao, which was one of the biggest Ponzi schemes and one of the biggest P2P failures. I think $1.2 billion or something worth of stuff got 1.5 billion renminbi was somehow fraudulently lost and all that. So that triggered action by the regulators. So I'm going to go through what's a little bit of a laundry list of things done. Kind of boring, but you have to know that this is happening. Regulation is never interesting, but believe it or not, a lot of people work as regulators, somehow earn a living, somehow make laws, and students have to learn about them. Okay, so let me go through a few of these. Now, first thing, in 2016, there were about 3,000 P2P platforms in 2015. In 2016, 1,300 of them were pegged as problematic and 900 were closed in the year. So the first thing that happened was after this scandal, this Izubao scandal, was the regulators moved in to clean house. So the hundreds and rather thousands of P2P lenders that had proliferated, they sort of got rid of a whole lot of them. The ones that seemed like, scams which gotten rid of. Okay. The regulation framework for internet finance was set in July 2015, when the People's Bank of China and 9 other ministries jointly issued guiding opinions on promotion of healthy development of internet finance. Okay, so this was the starting bell. This was the first major guidelines issued by the government. So remember, July 2015, this thing is done, whole bunch of ministries. Coordinating mechanisms among financial regulators are markedly strengthened by setting up a committee under the State Council of the PRC. So in addition to issuing the guidance, a new committee was set up under the State Council to act as a coordinating body to make sure that things were actually implemented. Then a Financial Stability and Development Committee was announced in July 2017. Guidance, the establishment of this committee in 2017. Just 2 things to remember. Okay, then you have, as I mentioned, cleaning up of these P2P platforms. This happened in 2016 and 2017. And as of May 2017, over 60% of the 5,900 peer-to-peer platforms had ceased to exist. So major cleanup by May 2017. All right, one other thing. Then the China Banking Regulatory Commission ruled in August 26th that P2P borrowing was to be capped, and it forbade platforms to act as financial intermediaries. So, all right, so the CBRC issued a ruling saying that P2P platforms could not act as financial intermediaries, and that the loans they could make would be capped. And the idea was, if you cap these loans, you minimize the likelihood of major losses. Because what was happening was, whenever something went bust, a whole lot of people complained, demonstrated, and the government was very sensitive to such demonstrations and therefore came down pretty hard on them. Okay, what else? All right. The other thing and this really surprised me, was PBC withdrew permission granted to these companies like Ant Financial to create their own credit scores. Remember, I mentioned earlier that one of the big advantages that these large companies had, who were harvesting a lot of data, was they could make their own internal credit scores by which they could determine who to lend to and what to charge. And so the PBC has withdrawn this, and now it requires that the China's national social credit system is the one that these companies should use in order to determine the credit worthiness of particular borrowers.
Professor,
Yeah.
is that like, did that rule kind of say that's the only thing that you can look at, or this is the baseline and then, you can do additional research? Because I would think, like, there's no way, if you're that company, that you're just saying, okay, you're good, we'll just accept whatever risk rating you've given this person and we're not going to look further. To me, like, I would think from that perspective, that's why would you do that?
Okay, I agree. Why would I give this up? And why wouldn't I sort of take it into a back room and continue fiddling around with it, right? Now, my understanding is that what happened, and please correct me, and you may know differently, is that the credit scoring information and all of the information gathered by the Tencents and Alibabas and others of the world, and Financial of the world, was shared with the government to form some sort, what amounts to a consolidated score. So it fed into the making of the social credit scores. And my sense is, and again, correct me, is that these companies continue to beaver away collecting information and processing information, and this is being continually shared with the central authority that determines these credit scores. Because, these are, not to use the information these people are collecting would be just crazy. From a regulator's point of view, this is a huge trove of information. Why shut it off? So my sense is this has now become something coextensive with whatever the state does. These companies continue to do it, but at least officially that's what they've been told not to do. That is, not to use their own, but to use this thing. But nevertheless, whatever they're gathering is already a part of this thing, which is presumably continually updated. Now, I'd hate to be in a situation where my social credit is being, calibrated on a day-to-day, because whatever I say to you on Zoom or whatever else I do, I go out and kick the squirrel in the yard and I lose 10 points on my credits. By the way, I do have a squirrel that shows up every day for food. He comes and sits outside and stares at me in the hope that I'll give him something to eat. Anyway, okay. All right, let's keep going. There's still a few more of these things which have happened. In March 2017, the central bank established a clearinghouse for all third-party payments. It was called Wanglian. So it established this centralized, and the whole point of this was that by having a centralized system through which all payments were being processed, it would enable the PBOC and the regulators to have oversight over all transactions, rather than these being done piecemeal by individual companies or being done piecemeal through various banks affiliated with the large companies. Okay, so that was another, and
Would you mind saying again what the date was for that?
Yeah, it's March 2017, and what was interesting here was that Ant Financial and Tencent collaborated in creating this and have a stake in it as well. Apparently, a 10% stake in this institution, in this clearinghouse. Okay. Okay, in May 2017, the central bank, PBOC, set up a fintech committee to act as overall coordinator. So this, to me, seems like it is this Financial Stability and Development Committee. So I'm not really clear whether this Financial Stability and Development Committee is separate and in the State Council, and whether this other committee is something which is within the PBOC. So again, something for you to maybe follow up, because I can't make sense of having so many committees doing exactly the same thing if there are two of them. March 17th, 2017, data protections were increased and entities were required to secure individual data. I don't really know what that means in a Chinese context. But okay, so privacy and data issues were flagged and given increased emphasis. But if everything is shared with the government, I don't know what the privacy means. So yeah,
I think this is related to the previous struggle between IPO and China in terms of the data storage issue.
Okay.
And like for example, if you're a foreign company, you operate an application in China, where will this data apply to America, or like where it will be stored and analyzed? Yeah.
Okay, right. This must be what it is. So it really applied to storage of data by foreign companies operating. So as you've heard, foreign companies have to store their data relating to China in servers in China. And this is something that is likely to spread to other countries as well, with everyone demanding that their data be stored in servers in their own country. Okay. More stuff. There are new rules which bar online lenders from guaranteeing principal or interest on loans they facilitate. Oh, really? Okay. They also cap the size of loans at 1 million RMB for individuals and 5 million RMB for companies, and force lenders to use custodian banks. So we've got three things here. You can't guarantee principal or interest. So typically, you're not a licensed banking system. The amount of loans you can make is 1 million RMB for individuals, 5 for companies, and you must use a custodian bank. So you can't kind of separate yourself from the banking system. So again, I think the idea seems to be not to allow a fintech economy to kind of coexist or sort of independently of the banking system. So an idea to keep them sort of merged together and make it to some extent much easier for the regulator to oversee them, and through this clearinghouse system to make sure that every transaction was essentially being tracked through the clearinghouse. Okay, unlicensed firms or individuals were banned from carrying out cash loans or micro lending. So if you didn't get a license to be a P2P or any other thing, you were out. Okay, micro lending was encouraged to alleviate the financing difficulties of farmers and small micro enterprises. Mo, is this something you are talking about too? Micro lending, did you encounter that?
I don't think so.
Okay, because much of this seems to be to rural areas and to the farming community and others. But a micro lending company is not allowed to absorb public deposits, blah, blah. Okay, so let's move on. Two other things. So So there is something called the China Internet Finance Annual Report. The one I've seen, the most recent one is 2018, but I believe they keep coming out. And there may be a 2019 report. I couldn't find it. I went looking for it the other day and couldn't find it. It reported as of 2018, high frequency of risk incidents have continued, but they have been contained more and more. Following the formation of standardized industry growth, blah, blah. The report highlighted the continued presence of pronounced compliance risk amongst certain internet finance companies. It also noted a fall in P2P platforms, blah, blah, etc. Okay, so try and see if you can find the more recent version of this, as I'm saying, as of 2018 and looking back to 2017 and 2016, there was still some slippage in regulation in terms of compliance on the part of these various lenders. And the compliance says whether they cap the loans, who they lend to, and so on. But it may well be now that things are much more under control. I have not heard of any recent problems with the P2P lenders in the last year or year and a half. Other problems have kept up, but not amongst these. Okay, now let's come to what's, I think, sort of interesting, which is what are the trends affecting fintechs and banks? I mean, now let's look sort of more into the future. Where do you see this system heading? What's going to happen, you think, and what are the trends suggesting? Okay, you, Emily, you look like you're going to say something.
I wasn't, but could you repeat the question? What the trends in fintech?
Yeah, what are the trends which are going to affect the fintech sector and relatedly the banking system?
Yeah, I think just like if the kind of coupling of the traditional banking system and the fintech system continues to be closer, if that will have an impact going forward.
Yeah, now what seems to be happening is that there is a kind of as we said, a convergence taking place where these very large fintech firms, because of the way they are diversifying, are acquiring many of the attributes of other companies. For instance, they're taking on some things which looks like insurance activities, brokerage activities, wealth management activities, and it seems, and of course, payment clearance activities. So they seem to be moving in that direction. And that's happening, as you can see, in the United States as well, with Google and Apple and all these, and Facebook coming up with digital currency ideas and payment systems and so on. So there's a convergence. And the banking system, recognizing that these competitors may eat their lunch, are also developing the same kinds of capabilities and moving closer towards the fintech sector. So this competition is a good thing. I don't know whether it's a good thing, but let's say it's happening. Certainly, it creates complications for regulators. But remember when we talked about whether you should have a single regulatory body or you should have many specialized regulatory bodies. So the question then becomes, if you see this sort of convergence taking place, should you have one body looking at everything, or should you again divide that body up into insurance regulators, wealth management regulators, what have you? Do you have a view on that? We may get that as an exam question and see what you guys say. All right, let's not answer it. Okay, we'll yeah, but that's actually I haven't thought about it myself, but I will think about it. All right, what other trends do you see? So this is very important trend, which may or may not have good outcomes, but could.
I think another interesting trend is that the central bank is going to issue a digital currency, and that could change everything. And also, there's also a trend for the Chinese internet companies to invest heavily in other online financing platforms overseas, specifically in Southeast Asia and stuff. So that's another step of international expansion.
Okay. So two things here. And by the way, on the digital currency and blockchain, we'll talk about it in the next class at somewhat greater length, because it's kind of important and important development for the future. And yes, they're going abroad. So here are two other important sort of spin-off trends from the emergence of fintech, because before fintech, no one ever talked about digital currencies, and no one ever talked about blockchain and what it could do. So now we have both of these, and these are going to affect, it's going to have profound effects even for monetary policy. And when you think about it, for the salience of the dollar, if digital currencies become, much more widely used, and China and other countries start to issue them. Okay, very good. Still there are many, many other trends out there. Yeah, Mo, Ben? No? Okay.
Well, are we talking about like generally the general trend of the development of fintech, or?
Yeah. It just any area which you can think of.
Yeah, well, as it is a database business, so I think in the future there will be a very rapid, like fierce competition in data collection. So I think for most of the company, they will try their best to collect data and specify it as much as possible to specialize their market and customers. So to enlarge their customers or the market proportion, I think.
Okay. Yes. So,
and
yeah. Go ahead.
Also, I think I gotta take a pause for a while and think about the others.
Yeah. So what is happening is that these banks and companies are establishing their own technology departments. So R&D and the establishment of technology department to systematize and enhance the collection of information is moving ahead very, very rapidly. So I expect that looking ahead, much more will go into this R&D activity in these companies than was the case in the past. That there'll be a big shift in the composition of R&D spending in this particular direction. And as you said, data collection will be very important, and particularly analysis of this data will become very important. And what the companies are trying to do, I think in addition to whatever they do with the social credit system, is to develop, early warning systems for credit risk and for systemic risk. So companies, in addition to whatever the government might be doing, are developing their own early warning system, their own means of figuring out what's happening in the economy and whether systemic risk is increasing or not. There's also a lot of development of biometric technology. So just in order to secure these systems, to make sure that scams are minimized, biometric development is a big area for many of these firms. So and also it helps to prevent fraud, because one of the big sources of losses for these companies is continual fraud. And so biometric technology is I've been working on that a little bit as you know, in the Indian case, it's gone really very far, and it's pretty impressive what they've done, covering nearly 900 million people. Okay, another thing that is happening is tech outsourcing. So let me mention what the Bank of China has spun off a separate company called the BOC Consumer Finance, which is also partnered with Tencent to launch a fintech laboratory. In addition, ICBC has partnered with JD Finance to digitize their services, and the Agricultural Bank of China has collaborated with Baidu and the China Construction Bank and Ant Financial. So another thing which is happening is that these banks, rather than do their own technological research and development are partnering with these other firms, the firms that are much further ahead, in order to develop this. So what we said earlier, that is not only is there a convergence, but there is an intermarriage taking place, and there's a lot of sharing going on as well. So this is actually interesting development, that you outsource your research to your competitor. Maybe that I don't know. Maybe that works well. I don't know what it is.
Professor, can I say my point? Yeah. So I think another point that I mentioned specifically in my paper, I just try to correct that, is that there's going to be a larger gap between larger and smaller banks, and smaller bank is going to, because smaller banks don't have the kind of capital to spend in the area of online banking as well as tech. So they are going to face more competition and going to, fail in this aspect. Also, I feel like the whole internet finance industry in China is targeting the retail banking as well as SME financing, and that it directly coincides with smaller localized bank is going to do. That's like the two aspects pushing them out of business.
Yeah, just to add on that, as I mentioned right at the beginning, that there is a move to consolidate the smaller banks in China, and the reason for doing that is that many of those smaller banks are in difficulty following the COVID crisis. So in addition to the reason you gave for consolidating the banks, because small banks really can't mobilize the technology needed, there is an additional reason pushing them in that direction. Someone else had their hand up? I've got two things here. Yeah.
Yes, just considering about the small institutes and also the like a growing regulation, also the safety and credibility that concerns from the customers. I think maybe the fintech market will be how to say it, platformized. I don't know if it is a word or not.
Yeah. Okay.
I mean, there might be like more or 1-2 giant like fintech platform will grow up in the future, so they can provide basic infrastructures and service to multiple small like fintech institutions or companies, and also increase the credibilities and the regulations to the customers.
Yeah, that's true. Okay, yeah, sure. Very good. Anyone else on this? Okay, one other thing to mention is that in addition to trying to partner with other fintech companies to develop financial products, some of these banks have created their own subsidiaries now. So for whatever reasons, they found it better to separate the fintech part or the research part of their activities from the mainstream and create a subsidiary that researches and explores opportunities for banks to get into fintech related activities. And China Construction Bank has done so, China Merchants Bank has done so, and China Minsheng Bank is also doing so. Creating subsidiaries is yet another activity they're involved in. And the whole point is that they want to move away from traditional banking. They want to maintain that traditional banking, but to sort of expand into areas where they see more opportunity for profit and where they feel they have to expand into in order to compete with these upstart companies that have emerged. Okay, what other trends do you see?
Sir, I guess it's not a very clear trend, but it's a possibility that the coordination among different regulatory or supervision agencies may have trouble in the short-term future, because like in the previous history, let's say like in industry emerging in China, then there will be like conflicts among different like ministries, because everyone wants to expand their jurisdiction and have different mindset about where this industry can develop. So for fintech, I really say that like right now, like I'm IT, MOST, and even like the public security ministry are stepping in and trying to make their voice. And because right now you have this newly merged CBRC, and they may have very different mindset compared with PBOC in terms of what's the role of traditional banks should play in this like new industry. So yeah, but I don't know what would be the trend for this. Yeah.
Yeah, I mean, you know, if we were talking about sort of a federalist system as the United States, I would see such a tussle as being inevitable almost, where different ministries and regulatory bodies are jockeying for position and jockeying for, you know, supremacy or a bigger voice in the management or the regulation of a particular industry. In the Chinese context, I'm not sure. I don't know to what extent this kind of tussle can take place at the central level. I can see more of a tussle between central administrators and provincial administrators. And I don't know what a leading group or a standing committee under the state council, what sort of role it can play. So one thing which could happen is that this financial stability committee and so on under the state council essentially determines the rules of the road, and that it prevents any kind of real sort of infighting between ministries. But it's hard to say. I mean, I really can't say. I don't know the dynamics. I don't understand these dynamics. But my feeling is they're less likely to be disruptive in China than in many other countries, in a Brazil or a India or places like that, where I think disruption could be severe. Let me mention, since we are running a little bit out of time, I'm going to run through a whole bunch of other things rather quickly. One is that telecoms operators are also entering this business. So the business is so attractive that China Mobile has created a fintech company, and China Telecom is creating this company. And the whole idea is that since we are selling you all these telecom services, which are so much like what everybody else is trying to sell you, why don't we sell you some financial services as well? So great. So here's another trend that yet more participants could sort of enter into this particular already highly contested field. Another item is 5G. Is that going to make it? And the question here is, and I'm unclear on that, will it spur more financial innovation? The fact that you've got this high-speed broadband, low latency kind of networks coming into play, will it mean more opportunity? I mean, and right now, I'm not even clear what those opportunities are, but you never know. And certainly there's a possibility. We've already mentioned that regulation of the largest companies is likely to increase. As these companies become very large, as they already have, even more powerful, there's more consolidation, as was mentioned, of smaller banks. You're going to have maybe 5 or 6 big players, big oligopolies that dominate this particular sector. Inevitably, it will mean regulators are going to be very active in this. There is a question of fintech talent. There is going to be, or is already the case, that if much more research is done in this area, if this field is a expanding field, it's the biggest, let's say the fastest growing field in the financial system of China, there'll be a massive demand for more talent. The question is whether that talent is there, or is this an area where China will have to give much more attention so as to provide the research manpower or people power and the people who will run these organizations. What else? Very quickly. Now, one other thing that has come up is that even though banks are trying to move in the direction of which the fintech companies have taken, and that is to try and share a piece of the pie that has been created by fintech, the franchise value of banks has been reduced. Once upon a time, these banks were the only game in town. Remember, if we go back 25 years, these were the only game in town. They dominated the field. Now they are having to share the action, and in fact, the fastest growing part of the action, with a bunch of other people, other companies that are equally large. And so the value of the franchise, they say the franchise value of the banks has diminished, and it is diminished in other countries as well. So that's another development. Will this continue, or will the banks essentially, regain their position? Now, remember, at one time, 5 or 6 years ago, the only advantage which the companies had was, these fintech companies had, was that they were more lightly regulated. So there was the possibility of regulatory arbitrage, and they were using a little bit more effectively new technologies. We've talked about those. But everybody now knows what those technologies are. And as I'm saying, they're doing research in that area. They've set up tech subsidiaries. They're entering into collaborative agreements. The regulatory arbitrage is gradually being eliminated because the regulators have moved in on the system. So if you look into the future, is there going to be any advantage which the newcomers will have over established banking institutions that already have deposit insurance, that have licensing to collect deposits, that have a large client base, that have a lot of experience, they have a broad branch network? So question is, what will be the advantage of the others? Will it mean that eventually ICBC or any of these banks will dominate and essentially squeeze out the newcomers, except perhaps Ant Financial or Alibaba or something? Something to be thought about. What will be the lay of the land 5 and 10 and 15 years from now, given that everybody will have access to the same technology? Three things that have come up for regulators to worry about. One will be financial stability. I'm just going to do this very quickly. So it's financial stability. Does the emergence of fintech further increase the risk of systemic instability? So this is something for which regulators have to worry about. Secondly, is the increased competition potentially destabilizing for the financial system? That is, if all of these companies struggle to try and make profits and introduce new instruments, vie with each other to attract customers, make risky investments, are we increasing the sum total of risk in the system? And so that is competition a concern? And thirdly, is a question of data rights. These companies are all collecting reams of data. The banks are collecting and so on. What are the data rights of customers? To what extent is this huge amount of data being collected on people somehow secure, somehow private, protected from hackers? As you well know, hacking is happening every day. And so if you have this vast amount of data in few places, in few banks, and hackers can access this, a lot of people may lose out, and the risk of fraud greatly increases. So that's another concern. Anything else? I think it was okay. For one other concern by the way, in the note, I'll quickly summarize some of this. One other thing for regulators is that, and we talked about this earlier on, is that if technological change continues to happen and to accelerate, keeping up with this technological change is going to be a real challenge for regulators. It was a challenge in the past, and it is a fact that they failed, which was partly responsible for the various crises that we have had. And now with this thing accelerating, either they limit the amount of innovation they permit. That is, they approach regulation with a particularly heavy hand and say, enough innovation, this is not leading to any productivity growth, this is not leading to any increase in GDP or consumer surplus, we're just going to check and we're going to just limit the proliferation of new ideas and instruments. Or they will say, let it happen, we're going to try and keep up with it and make sure that this doesn't destabilize the economy. So again, these are questions which regulators face and to which right now, I guess there are really no easy answers. All right, so this is all the ground we've covered today. Any questions? And I have a couple of things to say about next week, and then that's the last week we meet for for a lecture, and then you have your exam. So, any questions on this? As I said, I will issue I'll circulate a note which summarizes some of this information.
Yeah, Professor, just a very quick question. Build on Zijin's point. So right now, a lot of Chinese fintech companies are moving into Southeast Asia or South Asia, and for local regulators, they have been like struggling to decide whether to open this market or to highly regulate it at the very beginning. So, what would be your suggestion for like local regulator like to make a smart move?
You know, again, when we talked about foreign direct investment in the past, there are advantages, or at least many countries have benefited from foreign direct investment by banks from advanced countries into these countries because they bring technology, they bring expertise, they bring capital with them, they make the services more easily available to locals. So there are advantages. They also bring some of the regulation or regulatory procedures and processes from their home countries to the host country. So there's a big advantage. The disadvantage is that these large companies will come to dominate these markets and will prevent the emergence of local banks or entrepreneurship, prevent them from growing. This is known as the so-called banyan tree effect, that major large multinational banks or financial institutions reduce the prospects or limit the prospects for local companies to emerge, and that their interests may diverge from those of the host countries. So they may have certain objectives, whatever it may be, that are orthogonal to those of the host countries, and that if there's a crisis, these may pull out or take away some of the funds they've deposited from the countries they're in. So what would I advise? If you're a large country, a Brazil or somewhere, or an India, it's fine. You have large banks and so on. You have good regulators. You can manage. Not Brazil, perhaps, because it's too corrupt. But maybe India. Maybe Mexico is also a mess. Okay, some country out there. But if you're a small country, if you are a Vietnam or a Malaysia, I think you tread lightly on this. I think you can have a small subsidiary maybe just to get things started and bring in some technology. But if your financial system comes to be dominated by a couple of foreign banks, I think you may be in trouble. That's my thought. I'm working on Cambodia these days, so not sure. By the way, that's the heavy presence of Chinese capital now. Very heavy presence. And suffering also because tourism is dried up and all of that stuff. Anyway, any other things? And before next week we'll be talking about things like digital currency, something about blockchain, modern monetary policy, various aspects which are interesting and new developments. But also I'd like to try and briefly go over some of the ground we have covered in earlier lectures and answer any questions, queries you may have about anything we've done or about the exam. And also by next week, I hope you will be able to turn in your term papers so that I can, get cracking and grade them. Yes, Mo? I'm Ben.
Is the paper due on Saturday night? I think it's on the syllabus.
Yeah,
Or-
yeah,
okay.
Saturday is good. Sometime in the end of next week, just if you can. End of next week, yeah. 30th is, yeah, somewhere around then. Somewhere toward the end of next week, please try and finish your papers and send them across.
The
Sorry,
end
I
of
thought
next
it's
Huh?
I thought it's the end of this week.
Is it the end of this week? Oh,
The
wow.
syllabus says the 26th, but
26.
if you would allow us to do it end of next week,
Yeah, that'll be great.
Fine with it?
Yikes, did I say end of this week? Okay, well, how about the 30th is a hard deadline.
Okay.
Yeah, 30th. So you got another, 6 or 7 days to work on this. I've got so much work this weekend, I wouldn't be able to do anything at all. I've got, 3 papers to put to bed. So yeah, okay, 30th.
Oh, and by the way, what kind of citation format would you prefer? Do you require a footnote or just the author date will be just fine?
I use both. You can if you're citing by way of footnote, then give the entire citation. Or alternatively, if you find it easier, have it as a reference section at the back of the paper. People have used both. I'm open to both.
Okay, thank you.
Mm-hmm. Okay, guys. Well, have a nice, safe weekend. It looks like a rainy weekend for all of you who are here, and see you next week. Bye. Bye.